Good morning, everybody. It is the day after Thanksgiving, November 26th, 2021, and the stock market is very, very unhappy today because something that I mentioned in a webinar a little over a month ago is that in South Africa, there is a new variant of COVID, and it just hit the mainstream press yesterday. Now, I don't know why they weren't talking up this story a month ago or 6 weeks ago like I was for that one show, but they didn't. It's probably the same reason why in January of 2020, I told everybody that COVID was the biggest story in the world, and everybody looked at me like, what the hell are you talking about? I'm not going to retweet this. And then 6 weeks later, COVID was the biggest story in the world. If you're not reading full-time the way that I do, you probably miss this stuff. And most people don't have the time to read full-time the way I do. I just showed the AI that I use, the sorts of searches I can do on it. This search for COVID, only using professional journals, showed almost 250,000 hits. Think that through. Now, granted, it goes back, I believe, 5 years, but this is the sort of stuff that I'm reading. And I understand that CNN and even Bloomberg or Wall Street Journal, those are just journalists who, I'm guessing, for whatever stupid reason, aren't using this sort of tool. I guess the people at Bloomberg probably are, because this is a Bloomberg competitor. But I wonder why certain things don't get into the media fast. And I wonder why certain things don't become the narrative of the trading day when they don't or when they do. And there actually is an answer, so I don't wonder all that much. I've told you over and over and over again, if you want to follow short-term traders like Shooter here, you're using his technical signals. He doesn't study this stuff full-time. He studies technicals full-time, and he's awesome at it. But the narratives that you get from the trader community, I'd say 80 to 90% of them, are just flat out uninformed, and there's a good deal of them that are just plain out dishonest. Traders are traders because they're really good at following technical indicators. At least the good ones are. The rest are just chasers. And I talk to millennials over and over and over again who think that they're God's gift to trading right now. I asked one recently, recite to me your trading rules. I don't have any. That's what he said. When it goes up, I buy, and when it goes down, I sell. Well, here's the problem. An elevator drop, you can't sell. Why? Because they don't let you out till you get to the bottom. So on days like today, when the whole stock market's red, when people want to panic sell, all their stops got blown through pre-market. There hasn't been enough buying pressure to absorb the orders, hence why price falls. And why we've been seeing all sorts of small cap charts just get annihilated because there's no buyers. I'm going to tell you what, there are buyers in the small caps, and they are waiting for the blood in the streets because they know that in the small and mid cap space is where you get your best growth over time. When everybody in the world is pessimistic and thinks the world's going to end, people with cash in their pockets, which I've been imploring you to accumulate all year, get to go out and buy small cap and growth stocks and mid cap growth or dividend stocks dirt cheap. The reason we sell cash secured puts is because we get to collect premiums on things that go up, and we get to buy things that we like 10 or 15% below today's net cost if we had just bought the stock. The combination of being out of the money on our put and the premiums that we collect always, as a rule for us, get us a double-digit discount. And sometimes something that's down 70% goes down 90%. You hold your nose a few years and all of a sudden you're back up. So I understand the desire to try to figure out why did something happen today. But the reality is the reasons the things happened today were determined weeks and weeks ago, sometimes months ago. And this COVID outbreak in South Africa of a new type of variant is something, go back. I mentioned it, I think in September actually, but I'll find it. It was probably time I start bragging about things. So if you've been really paying attention this year, you've been able to accumulate some amazing long-term positions. And this correction and whatever happens in the next corrections are going to give you a chance, if you're behind, to catch up on buying those things. You want the stocks on the plug and play growth list. And you buy the basket. Don't try to outsmart me. I've read more about every single company here than you have any hope of doing. And I steal from some of the best people in the world, right? I belong to Insight, FS Insight with Tom Lee. I watch things like this Michael Saylor interview. The reason I bring this up is because I know that people are like, do I really want to spend $500 a year to trade with Kirk? Well, you're not really spending $500 for Kirk. What you're spending $500 for with a first year discount is Kirk and Tom Lee, Cody Willard, and Luke Grumman, and all sorts of other people. I had my list of research reports up a minute ago just because I had to refile something. I read a lot of stuff, take stuff from other people's letters, keep a history of charts. And I'm telling you this because if you're not subscribed yet, subscribe. Because in a market that's not easy because the Fed made everybody smart, I'm telling you, I've been through this a number of times in 25 years. There's going to be a lot of people who get slaughtered in the next 13 months, slaughtered. And I'm going to tell you why. Because whenever the S&P 500 gets overbought on the monthly chart, we get a rather large correction. There are no exceptions, none in history ever. If the monthly RSI gets overbought, there will be a correction and it will be substantial. It might come in 3 pieces or 5 pieces, but it'll happen. And with the Fed withdrawing support, probably going to happen pretty sharply. Now, can the Fed pivot back? Yeah, they can. We have seen Fed Chairman Powell do it before, and now that he's renominated, he'll probably do it again. I said this back in September. September must have been a good month for me. 1 year of anniversary of me having COVID, where maybe my brain is 100% again, 110% again. You're probably not going to see them completely unwind the QE program. So the first news you're going to get at the next Fed meeting is probably going to be, hey, we're not going to reduce any extra than we've already said. I don't know if that'll be taken as good news or bad news, but I do know that any withdrawal of liquidity at this point is going to be bad for risk assets in general. But the small caps are already pummeled. It's starting to move into the mid caps and the large caps. And once the very biggest stocks drop, your Apple, your Microsoft, your Amazon, once those stocks drop 20%, and we can officially call it a bear market, you probably already have had the mid caps drop 30-40%, and the small caps drop between 50 and 70%. And a lot of those 50 to 70% corrections are already here. And people like Warren Buffett can't really buy a lot of small caps because he has so much money. But there are a lot of billion and $2 billion and $5 billion and $10 billion funds, and Cathie Wood, who can, and they will. So if you're not tracking ARK Innovations buys and sells, you should be. Just go over to their website and subscribe. You'll get an email every day. You can't look it up. It only comes by email every day. It'll tell you what they're buying and selling. And since we have about 15 or 20 of her stocks in our 200 stock universe, it's useful information. So just go through a couple of things here. Tom Lee has a whole tracking system here. His FS Insight for, and I don't have a code for this. You just have to use this Black Friday sale. You get 2 months free. Then after that, it's $250 a month. I would encourage you to take the free trial just to be on his mailing list because he puts out some good stuff, and then quit before you have to pay for it. Because $250 a month, if I'm already reading it, unless you're going to live in here, it's not worth your time. But it's nice to look at for a couple of months just so you understand some of the types of information that I'm getting. You already know about Forest for the Trees. And they don't have a discount code either. In fact, when I was running as an affiliate with them, and I still am, I think we got in there at $99 a year or $199 a year. It's now $99 a month. So a lot of the good groups go up in price. Fundamental Trends is going to go up in price too, probably next year sometime or very early in 2023. So if you want to lock in your rate, you should do that using this Holiday 67 code. And if you're already a member, you have something just a shade better than this, and nobody's ever going to get the deal that you have if you're already a member. But this Holiday 67 code is something that you can use, and that gives you access to a lot of things I read. Now, the technical strategy here, Tom Lee is saying that things are going to push back up again, but he also had a annual slide deck here that he put out a couple of weeks ago, and the top of the thing here that he put, the COVID-29, COVID is like the number one risk. If it flares up, all bets are off. Well, it's flaring up. And India is facing a healthcare catastrophe. I think that stagflation is probably here right now, and we probably won't get out of it for about a year, a little more, a little less, because the infrastructure bill is going to have very little impact in 2022. They're just going to spend 2022 getting things contracted. You won't actually see infrastructure deals really getting off the ground until spring of 2023. And there will be some in the good weather states or the warmer states to get off the ground by autumn of 2022. But for the next year, I think that we need to be very, very cautious because these COVID variants are dangerous. I know it's something that people got tired of hearing me talk about a year ago, that this risk was going to be pervasive until most of the world got vaccinated. And that's a pretty big challenge because even in the United States, where we have twice as much vaccine as we need to vaccinate everybody, we have a third of the population that either by ideology or lack of intelligence or confusion or just being stubborn or just being scared in a lot of cases aren't getting vaccinated. So in the rest of the world, they're short on vaccines. Not the rest of the world, but about 2/3 of people on the planet actually don't have easy access to vaccines. That's why it's important that we just ship it out all over the place. Get as many people vaccinated as possible, particularly in places where they don't have great healthcare in general. Diseases breed in petri dishes of people, and when you have a powerful one like this, that we don't know how deadly it truly is yet. On unvaccinated people, it's pretty deadly. On vaccinated people, it's like the flu, right? You're still going to get a handful of deaths, but for vaccinated people, the flu and COVID probably isn't going to kill you or even have a long run effect. So the logic people use is, well, I'm willing to take that chance. Aaron Rodgers, idiot. Here's the problem. Even if Aaron Rodgers can get over it pretty easily because he's a superstar athlete, that doesn't mean that he didn't help develop something new that's going to hurt somebody else. And that's why I hope they trade his ass. Get us 16 first rounders for the guy. I don't care. He's 37 years old. I loved watching him play. I'm a Packer fan. And I still want him to win us a Super Bowl. We could trade. Because I'm getting more and more irritated as I get older with knuckleheads. People who can do a few things really well and then think that everything in the world they say about everything else matters. And that's why COVID's coming back. Because so many people push back against vaccines the way they've done in the past, right? That's nothing new. But the economic impact of this is unheard of. It's unheard of. COVID, short of all the QE, was far worse than the Great Depression. We just bought our way out of it. But how long can you run on the dole? The bills coming out of Congress now, again, I've told you, they won't have much impact next year. The reconciliation bill will probably have more impact than the infrastructure bill once it gets passed. And at least these bills are basically budget neutral. They're going to be really close to balanced combined because the infrastructure bill is actually going to be a little bit positive on the federal budget. And even if you take the economic benefits outward that the government doesn't get, but the rest of us do, it's tremendously profitable for the country. Reconciliation won't be profitable for the country. It'll just raise the safety net, raise the standard of living from the bottom up rather than the top down. All these things take transitioning. And in transition, what do we know? A lot of risk on the front end, a lot of opportunity on the back end. So I don't know how fast these corrections are going to come, but ultimately, we'll get back to this. If there is a big pullback, then we'll get pent-up demand again. Then operating leverage will come back. Probably going to have low inflation rates forever, and reflation will come back. And the millennials, which I've been telling you about for years, once they get into household formation and investing, and they are investing more as a percentage of their income than the boomers ever did, are a major tailwind. And they're also the ones who pick the winners and losers in the market. And then there's no alternative to stocks will come back. And the Fed, we won't have to fight them because they'll be back on our side at some point, like I basically say here a couple months ago. So what's going on right now? On the monthly chart, the S&P 500 is overbought. There's been a major correction, right? .com crash came after this, financial crisis after this. We actually had 2 flat years in the market with a couple of corrections here. We had the 2 big corrections in 2018, and I think this would have gone up a little higher had it not been for COVID, but we were setting up for a big correction in 2020 either way. And now we pumped it up as fast as we could with QE money. Now we're set up for another correction. And maybe COVID is the catalyst, or maybe it's all those valuation charts that I showed you. And we know something else. We know that as the dollar gets stronger, which it will because the Fed is pulling back, risk assets generally go down. How do we know that? So this is my portfolio of all my ETFs. I want you to see something. This is UUP, Invesco Bullish Dollar Index. As the dollar goes up, everything else goes down. What does the negative number mean on correlation? It means it's moving in the opposite direction. So take a look at S&P 500. You can see that all the other ETFs, mainly equity ETFs, but also some bond ETFs, as the dollar goes up, look, every single risk asset category goes down by some amount. Negative all the way across, all the way. So as the dollar rises, every single risk asset category falls. Every single one. There are no exceptions. You don't see a positive number here anywhere, do you? Every single risk asset falls when the dollar goes up. So what we want to do is we want to find risk assets that are less correlated to the S&P 500 and to the dollar. So here we have the cannabis fund that I like, which I've been telling you about for 2 weeks. That was getting really close to being a buy. So it's not very correlated to the S&P 500. Right? The number 1 means 100% correlation. And the negative number associated with the dollar isn't terribly high either. Somebody threw a question in there about gold, and I was going to get there. So if you go back to gold, there you go. Pretty negative correlation to gold and gold stocks when the dollar rises. Now this isn't 100%. Off of a bottom where the dollar hasn't gone all the way up, but off of a market bottom where gold stocks are oversold on RSI, a longer term chart, weekly or monthly, you can get a brief period, a year or two, where dollar and gold stocks go up at the same time. But as you know, over the last several months, I've become a little bit less enamored with gold stocks for a couple of reasons. One, the reality is that they have limited profit margins. As more gold demand occurs, gold gets harder to get, they have to spend more to get the gold. So I told you way back when we bought the gold stocks a couple of years ago and in March of 2020, but we were buying them before that too, a couple of years before that, is that at some point, physical gold will become the better investment versus gold stocks. And they were probably there or really close. So I don't know to the extent that I'm going to own gold stocks anymore. So I just don't see there being a ton of free cash flow for them other than Barrick and Newmont maybe, for really anybody else. Because gold mining takes massive scale and the juniors don't have that scale. And there's probably a handful of others, Kirkland, a couple others. But for me, I'm just going to stick with Barrick and Newmont. They're the two 800-pound gorillas. So I probably won't own GDX in the future. I'll probably, if I want to own gold stocks, just buy Barrick Gold and Newmont. If you find one that's trending real hard and you want to trade it, hey, dandy. And I'm probably not going to buy any gold ETFs either. If you truly want gold as a long-term inflation hedge, it's something that's just cool to have that might someday be really valuable because there's a shortage or just because it's cool to have, then start buying the little gold bars. Maybe I should put something on the website. Maybe I should find a good place to do that. I usually just buy it locally, but there's got to be probably somebody online that's worth buying from. But usually your local dealers are going to give you the best deal if you're in a big enough city. I mean, you may not have one near you, but if you're near a big city, there's gold dealers, and they're probably the best ones to go to. And cool gold coins are probably going to be worth a whole lot more, right? That's why collectibles kick ass long term. That's why art goes up so much. Gold doubloons, all sorts of different gold coins go up a ton in value. And I know those are harder to sell than selling some ETF because you got it in your hand and it's tangible. That's one of our subscribers says you buy gold coins from banks called Centenarios. Did I say that right? I think I did. All those sorts of things. For the most part, in your investment portfolios, you don't want gold. You don't want gold stocks, except in these handful of places where you can find some economy, or if you're trading. I will say, the shooter is a whiz at trading some of these commodities because he comes from an environment with some of the best commodity traders and futures traders in the world. So when he talks about oil in the short term, because he gives two shits about the long term, you want to listen. When he talks about gold in the short term, you want to listen, because his trades are usually pretty darn good, because he's using technical indicators, and all the noise from all the narratives that probably don't matter in the short term just become a technical signal. And to trade it for 8 days, which is his target range, or 2 weeks, or 3 weeks, or 4 weeks, if something runs. So we're at fundamental trends. I tell you, that's the one thing that you really get that you don't get a margin of safety with us, is that fundamental trends. You get, if you want to trade 10 or 20% of your portfolio, you got a heavy hitter over here doing it. And he's doing it for almost nothing right now. So I'm just giving him a cut of the growth of the site. So if you want to trade, remember, take into context who you are and what you do, how you invest. If you're a trader, go to fundamental trends. If you're not a trader, margin of safety is awesome for you. I think it's the best position trading site on Seeking Alpha, even though they don't advertise it that way. Something neat about Seeking Alpha is they take about 65 to 75% from all those advertisements you see. So when they say our top 3 stock pickers, they're full of shit. You go on tip ranks to see that's not true. But because they're taking, 70%, give or take, they'll advertise it that way. So let's take a look at a couple other things for on the investment side. I talked about oil. Let's take a look at this chart. I haven't moved that. I marked that point on the chart with the word sniff, meaning I think we're sniffing a high. Look where it's gone since. So long term, we know that oil is in terminal decline over the next however many decades. And we know that one of the big oil catalysts down is going to be EVs taking off in the middle of the decade. Because I've been telling you since CES 2020 that was going to start happening in 2026 and 2027. Because that's when the laws get so strict on mileage and all the supply chains and all the economies of scale for manufacturing are in place. And there's all sorts of lithium coming on in 2023 and 2024. So there's no shortage of materials. So suddenly 5 years from now, oil will come off of its peak oil plateau, where we'll have relatively stable oil demand, maybe going up a percentage point a year, maybe. It doesn't every year. They'll say one goes up 1% a year for the next 3, 4, 5 years. And as people start buying the EVs with all these tax incentives that are coming online next year, at some point, there's a tipping point and demand for oil falls. So what you're seeing today with COVID, which will probably get over sometime next year, been saying it for a long time, as more and more people get vaccinated and more people get it, more and more people die, 700,000 in the United States. Remember when they said we wouldn't get to 5,000 and then 50,000 and then 100,000? And I said we might lose 1 million people? It's because we can't get out of our own way sometimes, locally or internationally. But oil's dropping 10% today because of something we already knew. What happens in the middle of the decade when all the oil producing countries start pumping as much as they can to avoid stranded assets? You're going to get another massive wave, probably sooner than 2026, of US oil companies going bankrupt. And again, I agree with the CEO, probably the best oil company in America, Pioneer Resources, that there's only about a half a dozen viable US oil companies. You will look at XOP, the ETF, and if you are owning oil stocks right now, and I've told you this 10 times, maybe 20 or 30, if you're not using this trader's rally to trim these positions, you need to. Now, maybe not today, but on the pop that comes after this at some point, but you should have been already scaling out. The next day, the next 4-hour period or day that it's up 5%, sell something. There's only a half dozen viable US oil companies. In fact, I will write that article for Seeking Alpha just to piss off all those oil bulls. So again, dollar's rising. We see what that means. What does that mean for some of our specific ideas? Cannabis fund is down. Let me skip up here. This is a variation of the hype cycle adoption chart, right? This one's from Bain Capital, Mitt Romney's company. You get your hype. It's not fast enough. I have problems with it, blah, 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 valley of death, and then adoption, okay? Something happens. Execution of the idea, manufacturing scale, right? Whatever the catalyst is, sales, whatever. Just time to get things in place. That's when you get your second wave of growth. So as you look at these charts, start to see we're in the valley of death on some things. And on others, it's coming. So on the weed stocks, we're pretty much there. You can start scaling into this ETF probably today. It's down 5%. And it had started up today and it was up the other day. So I think that this COVID thing just giving you another chance to buy. I think 15-ish is the bottom fishing, 14, 15. But you should be probably nibbling in and getting a starter, even if it's just a little tiny holder position, which is what I have. I have my limit orders set at 15, but I might lower them to 14. Let's see how bad this route gets. But you need to pay attention to this one every day because you want to build a position here. Why? Because growth in cannabis and weed is going to be like the growth of alcohol in the 50s and 60s. And these companies are the survivors, and that's where we're getting to right now. We've whittled out dozens and dozens and dozens of shit stocks in the cannabis space. We're getting down to survivors. Remember, this is a managed ETF, but some of the other ones are more formula-driven or index-driven. They all correct themselves, right? Because they get rid of the losers. And what we're starting to see are portfolios or baskets of marijuana stocks that are full of winners. Now, if you're really an expert on that area, you could probably pick out half a dozen winners. Tim Seymour, who you see on CNBC all the time, is one of those guys that knows the area really well. Like one of the best in the world. So that's why I use this instead of MSOS. They perform pretty much the same, right? Seymour does a little bit better in the direct comparison for the same time frame. So if I'm going to try to figure out this market, I think maybe the thing that I'm going to do is I'm going to buy Seymour cannabis for the long term. I probably trade the options on MSOS, sell some puts, then write covered calls, sell some puts, write some covered calls. But this Seymour, I think, is going to be my long-term position. So in the article where I compare the cannabis ETFs, I will talk about how I'm going to invest. But that's basically how it is. Long-term position in Seymour, then I'll generate option premium with MSOS. Somebody asked about decriminalization. Marijuana is basically already decriminalized. We just need a federal statute to take out these last, whatever it is, 15 states where you're allowed to marry your cousin but not smoke weed. Yeah, we have to deal with that. Because honestly, if we're going to allow alcohol, it's dumb not to allow this federally, right? So the parallels are there. And there's actually bipartisan support to just have federal blanket law. So it's coming. And in fact, I think that if anybody ever got this to the Supreme Court, they'd probably win by saying, look, there needs to be a federal law because the state stuff doesn't make sense. All right, so let's jump over to emerging markets. I told you not to buy the commie stocks just yet. I told you that I want EMQQ closer to 40, not 50. And now it's at 46.84. I'm going to look up the options, see if it's almost time to start selling puts. When you take a look at this chart, you're seeing big selling right now, which coincides with the people who were big buyers over here. So they've been trickling out. Now the last ones are selling. Oh my God, I'm down. So people who sold up here are out. And the people who bought from them up here been taking their pain. Now they're probably going to take a lot more. If we go back to about 2018, you see there's a lot of activity in here. So let's cut off that. And I think this is the relevant area. Buyers, sellers, buyers, sellers, buyers. So we had a group of buyers, probably people who never sold, but some did, then buyers again. This area right about here, right about 40 on EMQQ, I mean, there can be momentum that goes below that level for sure, but right about 40, this is a pretty important area. Didn't break it here, didn't break it here, but it broke it here. And pretty much everybody that bought below here is a winner. Some of them might be taking profits now, but this area here is where the vast majority of people are still profitable and they're not likely to sell because they're like, look, we're fairly sophisticated. We were bottom fishers. You know, can we get close to 30? I guess if everything goes to hell. But I think probably right around 40 is where you get your starter position, where you sell a put when the strike price minus the premium is about 40. And if it gets down to here, well, then you back up the truck. All right. So that's where your back up the trucks are. They're actually probably right below that level. There's your back up the truck. Rare earth metal stocks, some of them got beat up today, but you look at the group, still pretty strong. It's up on the week, on the day, down about 4%. So if you take a look at that daily chart, right? Can we get back down to here? Yeah, I think if it gets down to around 100, you got to buy it, unless there's huge downward momentum. I think it's very unlikely. Take a look at the longer term chart, right? This is your smart money buying. And it chops for a while, starts to catch public imagination. A lot of people still don't understand what rare earth metals are. And you still have a lot of skepticism about the clean energy transition. You know, people want to blame clean energy for the reason oil prices are high, which is just monumentally stupid. Clean energy has all been additions. The manipulated oil market, which is clearly the most manipulated market in the world, causes its own problems, its own price spikes and crashes. You know, and all your little narrative-driven traders, you know, oh, this is what justifies my trade. Shut up. Just tell me it's your technical signal, because that's what it is. You don't have enough information to make a qualitative analysis. Anyways, it's bounced off here twice. I can't tell if it's going to go below it. We'll know in real time when it gets close to there. But this is another one that you got to keep an eye on, because the rare earth metals are incredibly important to the clean energy revolution. And if we can get a bottom fishing price down 80-ish, you know, you're probably in real good shape there. So I'm going to break down this fund by company, because I want to see what the top 10 holdings are doing, what their valuations are, what the growth rates are, and see if we should really be targeting up here, or we're likely to get a breakdown to here. My guess, just kind of understanding wave theory, is my guess, so we probably do get down into the 80s. I'd be interested in a shooter chart on that, but I haven't done the work yet on that. I just know that it's based on when I did this analysis back here, right? That's where these lines usually come from, and then I move them when I update them to the current date. So when I broke this down in August, right, it made sense to me that we could get down to about here, and that could change as we come down, right? Ding, 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 boink, ding, ding, ding. We'll see. But you want to keep an eye on this one and companies like MP Materials. And MP Materials is unique because of the battery production and the processing. They're not just miners. They have a mine, but they also have the processing and the magnets. So these guys get back down into here, and I really believe that they're gonna set a new period low. I mean, I really can see them in the 20s. Maybe not. Maybe there's too many people who want to buy this. I can really see this one down here. And if it gets there, you want to own it for these reasons, because this is going to be one of the biggest beneficiaries of the EV revolution. Some other companies, PayPal, right? Again, look at this. Look at PayPal. Probably goes way up in coming years. So at this point, we're just trying to find this. This is what I would consider a top 25 growth stock, intermediate and long term. Right? So we just got to find the spots in here to buy. Right? When I did this, I actually moved this one back. I did this chart up here. But this spot right here is important. That's why I moved it back. You know, when I put bottom fishing prices and people tell me it's never going to happen, when this stock was 300-ish, I told people to go under 200. And they said I was out of my mind. Here we are. Square. Square's going to get under 200, no doubt. Will it get all the way into the 150s, 160s? Here's what is hard to understand. So you move your chart to right where the big action started. People were accumulating. COVID gave them a second chance and they accumulate. Pretty smart money was buying. It breaks out here. You get your traders push the momentum, right? Breakout. So what happens with breakouts? The traders jump in. Stutter steps, narrative, Bitcoin, narrative, all the way up. Till it gets to the point where you just run out of people who want to buy it after that rally. And it chops. Now, cryptocurrency regulation, slowing economy maybe for a year, or choppy economy for a year. Inflation, coronavirus, making us all think it's going to shut down again. You get this fall into this area where I told you. And this is where you start to see a consolidation area, right? So this area marks an area of consolidation. Now, can momentum bring it down here? It can. And if it does, right, does get down here, right, to this breakout point. If it gets back down to about this breakout point, you sell your children, become a renter, get it bust down by the van, a bus down by the river, right? A van down by the river, and you load up. Because this is another one. Once it's in the valley of death, you need to buy it because of this. Teladoc. Well, yeah, a lot of these charts look alike, don't they? And Teladoc's probably here, right? Nobody believed it when it was up here. They get down here, and here we are. To under 100, I think, is looking pretty certain at this point. Then again, look here. Here's a 2018 peak. Then this is one of the COVID winners. But look, it was already doing it way before COVID. This is a winning stock. It's down month to date 25%. What is it today? Today it's up a little. We're in the buy zone. It might rally and then fall again. But I don't think it hurts you to take a starter position here. I really don't. But maybe wait until Monday because somebody will say something positive over the weekend. And then, oh my God, COVID stocks suck again. Speaking of COVID stocks that suck, there you go, Zoom. Notice the chart. Notice the chart. But this one isn't coming down as precipitously, right? It doesn't look as harsh. But then you realize, oh, it's still down 50%. When I built this chart, everybody said, no way. 150-ish, be my guess. Now, when you get this close to the buy zone, you have to watch pretty much real time every day. And now you have to start paying attention. Okay. So Zoom might find its way onto my list because I think that their platform, and we're going to talk about platform companies for a minute because somebody asked a question. You know, I like platform companies because they have multiple ways to make money and they're very low cost to operate, right? So they're basically subscription-based revenue models. They can add lots and lots of revenue without adding much input. It's all adding to the margin, to the bottom line. You've seen what companies like Amazon and Microsoft and Google and Apple can do with that type of a model. So when the total addressable market is huge, a platform company can do very well. Well, Zoom is incorporating different types of communication. It's not just little group webinars now. They have two different types of webinars. One for doing mass presentations and getting into the multimedia, into the mass media. So with Zoom, the meeting that we're using is their basic one. But if I really wanted to broadcast this, if I wanted something that was going to be for CNBC, or if I wanted something that was going to be for Bloomberg TV, or if I wanted to really have a YouTube channel that screamed to hundreds of thousands of people, the other Zoom platform, which is made for mass audience, is pretty interesting. And you're already seeing it be used by the types of outlets that I just described. And they have telephone, right? They have voice. And they're going to add other things. And it's not going to cost them much. And then people like me get nicked for $5 extra a month, and $10 extra a month, and $20 extra a month, or $100 extra a month if you want the big thing. I think the best package they have will cost me like $100 a month. And then if I want to make it enterprise level, you know, because I grow to be huge, you know, now I'm spending lots and lots of money. So I think Zoom, like Teladoc, like Square, like PayPal, these are all long-term winners. If we can get them in the valley of death, we're going to want to buy them. We get our second chance because the next wave of growth will be way bigger than this first hype cycle. Because the winners, like your Googles, your Amazons, your Apples, your, you know, whoever, Microsoft, once they get scale and they become the choice, like Google. I mean, there's all sorts of search engines out there and we still use Google. Why? It's freaking Google, right? Do you use tissue on your nose or do you use Kleenex? You know, maybe you're one of those weird puffs people. Platform companies that become big, like Adobe, right? Acrobat, they just start spewing out money at some point. Back when Amazon really took off, it was why? Because after being in business for a decade and not being profitable, Bezos said, okay, we're ready to be profitable. He flipped a couple levers and bam, they started gushing cash. And now he's at a point where, and he's not really running the company anymore, but now Amazon's at a point where they can say, to keep market share and continue expanding market share, we're going to just have a break-even quarter in the fourth quarter because we're going to make sure you get your package. That expands their network. That makes their customer base more loyal. What does that mean? It means if you get a chance to buy Amazon on this dip, if we get it, I think we will. It's probably a spot to buy Amazon again, and you ride it up all the way to the point when they decide to spin off AWS because they have to. They're going to spin off AWS and unlock all that value. Then at that point, you keep AWS because cloud's going to get even giganticer. You probably sell the retail side because, you know, at some point, there's just so much money you can make in retail once you're the dominant force. And we're getting to that point on the retail side with Amazon. That's why I said peak Amazon. What, 6 months ago, 7 months ago? All right, somebody asked a couple questions. Somebody asked about Wejo. I just don't know anything about it. I'll check it out. I've got your question. I saw it in the chat room, so I'll take a look at it. I mean, I like the idea behind it, right? It's data for EVs, basically. It's going to probably drive AI and things like that. Any other questions that I can get to today? A couple smart ideas here. Yeah. So one of the things about Wejo that I will say is, right, it's backed by GM, and Microsoft has some sort of deal with it. I can see that in the summary that I'm looking at on the other screen. Remember how Ford, I told you, could do all those things, almost 2 years ago now, right? 18 months ago, whatever it was. It was February of 2020. I told you Ford was going to be a big deal. And they're up 300-400%. In fact, that's the last stock we're going to look at is Ford. Ford was a big favorite of the Robinhood crowd and the Reddit crowd. So you wouldn't expect that to change. So back here, when I was telling you to buy Ford, and here and here and here and here, they hadn't really started buying a ton of calls on it. And they've had waves of calls. And the biggest wave of calls is up here. So look how this is the wave of calls from the younger investors. First correction, push it back up with calls. Second correction, bigger, but only to about this peak. Now they have this one and it's turning over. So again, I think it for sure gets into this 15, 16 area. And depending on how bad the market gets, maybe you'll get lucky and get another price down around here. See that peak, this area, consolidation. It's going to be tough for Ford to get below 13-ish. I think it might even be tough to get below 16-ish. But those are your two targets. These lines are about right. So if it gets to here, make sure that you're selling puts if you already own the stock, or buying shares, but I'd say probably selling puts. Again, we'll measure the momentum downward in real time when we get close. Usually it's somewhere between 1 and 8 weeks. You get your answer on how low it's going to go. And that's just cyclically how things work. And if it gets down to 13, here's your truck. If it gets down here, you back up the truck, baby. Back up the truck. Because Ford, with its partial stake in Rivian, with all of its real estate, with all the deals they can do because of their technology, and their technology is better than Tesla or GM. I think they have the best technology in the world for auto companies. And I know you split hairs on stuff like that, but their fourth industrial revolution in infrastructure, technology and industrial infrastructure, I just don't think anybody matches it. I mean, they're global. They have more of everything than anybody else out there at this level. There's little companies that probably are going to do really well too. But for the big companies, given the interest in the company by millennials, the fact that they're understanding this company a little bit more every day, as the information gets out there on the 4IR technology, and them unlocking value in the real estate, and them cutting deals with other companies to help them develop and take a cut, like Rivian. I really think Ford is going to be $100 stock by the middle of the decade. 2025, 6, 7, right in there, somewhere in there. So this is a 5-bagger that if Tesla is an example, and these guys start putting up Tesla-like numbers for EVs, which I think they will, maybe it's a $300, $400, $500 stock. Because what do we know? QE is forever, at least the rest of this decade, probably parts of the next. I am doing a lot of updates on the very short list. I broke it up into a growth side and a dividend side because I want the dividend investors, right? I want the dividend investors to have a little easier time. If anybody's a spreadsheet guru, Dimitri, if you're watching, or anybody else, I don't know why these dividends aren't showing up. And I know it has something to do with I broke the sheet to rebuild it. So if somebody wants to help me figure out how to get these unpopulated lines, that would be great. Because I'm just not a great spreadsheet guy. And I've been updating all the buy zone charts. And okay, last but not least, I know I have, bar charts and another thing that I use. This is the reason I subscribe to this is exclusively for this and for the options. Unusual options activity they have, but then just the best performing stocks over different periods. I could pick, what stocks have done the best for the last month. What have done the best for 2 years? And I've told you before, 2 years is an important interval because you compare it to 5 years, see if it's really a long-term winner, and then you do your short-term 1 and 3 months and 6 months. That shows you where the momentum is. And relative performance is a thing. a lot of stocks that I invest in, right, come off of this list. And I don't buy the ones at the top. I buy the ones, I flip it over. There you go. I take a look at these. Because these, if they've just started moving, pretty interesting. So I'll compare the 2-year chart to like a 6-month chart and then a 1-month chart, 3-month chart once in a while. Relative performance is important. So let's take a look at SunPower. Up 300% over the last 2 years. Oops, I don't know why it did that. So you take a look at SunPower. You take a look at that. It had that big spike. Now it's come down. Another valley of death thing, right? So we get another bite at the apple in the 20s, lower 20s. Probably want to buy that because the move has begun. Now we're going to get adoption of solar. Okay, the other last stock we'll look at. See what I'm getting at here? I think this, probably raise this a little bit. Add this breakout here. It's a pretty strong area there. Right about there. That little volume pop gets support there. See the volume? Probably the first bar is selling, the second bar is buying. But support usually moves up a little bit. I'll say the reason I'm ending most of these boxes at 2023, I'll tell you what, when these infrastructure bills really kick in and the reconciliation bill kicks in, it's a big deal. It's a big deal. Yes, somebody is now posting, COVID's not going to end the world because Moderna and Pfizer say they can fix it. So look for your opportunities between now and next year. Scale in, stick with your best ideas. I'm updating the plug and plays to my top 25 ideas for next year. You're going to get your opportunities. SunPower is going to be one of our top 25 growth stocks because as it expands out, as it grows out, it's not just putting solar panels on things, it's monitoring them, it's handling the energy flow. They get paid for all that. I'm encouraging my wife in waiting, my future fiance, to get a job with one of the solar companies in the Midwest. There's 2 of them we're looking at, one in Milwaukee, one from Iowa. And the reason being is that the growth rates are going to be in the 30s, 40s, and 50s for a really long time. And the day is coming. There's one of these things you remember for 2 or 3 years down the road. The day is coming when solar is mandated on certain types of construction. But the big money in the short term is all these commercial properties, all these companies that have supply chain moving back in the country, all these big boxes where they manufacture something or store something. You've already seen it at Kohl's and Walmart and Google and Apple. It's going to be every company in America is going to have solar on the roof, almost. They're getting tax incentives to do it. It makes the power grid incredibly efficient. Once there's a network, it's going to happen. So the last thing we'll look at is PBW. Here you go. So maybe my bottom is a little bit too low. There you go. Get your PBW 70-ish is what I'm guessing, 70 something. And this, if you're an ETF investor, solves a lot of problems for you because there's companies like Generac in here, SunPower, Enphase. You just buy the basket. So you're going to see a series of articles where I say how to invest in clean energy, how to invest in marijuana. And that's what these will take into account of, both ETF, stock, and blended ways to do it. Because we're getting to the point where the prices are telling us that once we get out of the malaise of COVID and moving supply chains, and oil stabilizing, and inflation numbers coming down over the next several quarters, maybe through the end of next year, that next wave up, what's coming in a year or two is this. All these technologies I've been talking about, all this supply chain movement I've been talking about since the Trump administration, early in the Trump administration, is all happening. So we had our hype. We're going to experience the valley of death, and you ought to just load up the truck. And then you're going to get years of some of these companies growing. And then something bad will happen someday. You have to respect the cycles. That is actually one of the things that Tom Lee said. 7 principles. I posted this on the chat boards. Nothing new under the sun with markets. The importance of looking at cycles. Number 1 thing for him. When you can recognize that this is happening and you have cash like we do to deploy down here, oh my God. I'm telling you, you stick with me and we buy these growth companies down here, a lot of you are going to be another 0 richer. 100,000 is going to be $1 million. $1 million is going to be 10 million. It'll take until the next decade. But if you could 10x your money between now and sometime in the next decade, would you be okay with that?